Welcome everyone. I'm Jason Gentile, the Chief Wealth Officer here at Apella Wealth. Thank you very much for joining us again for another Apella Wealth session at Apella Academy. We're very excited to have another great, timely session for all of you today. It's also nice to host events like this when the market's up. Couple of quick things that I want to just mention here before we get going. We're going to use the Q&A feature to ask questions as you're all muted. This session will be recorded, and importantly, if you miss anything, you can go back to it. It'll be posted to our website in a couple of days, but we would also encourage you all to share with family, friends, anybody who might be in need of information around markets or any of the educational sessions that we do. As it relates to the questions, we're going to do our best to get through as many of those questions as we possibly can throughout today's presentation. I'll be monitoring those, so please keep firing them away. And if we don't get to your question, I promise we'll do our best to get to it after the fact and pass those along to your financial advisor if we can't get to them specifically. For anybody who's missed any of our previous sessions, maybe this is your first time joining us for an Apella Academy session. Recently, we just finished up a Social Security one last month, and prior to that, we did a review of taxes in 2025 and different ways of reducing those taxes. So please go to our websites, check under events. You'll find all of our upcoming sessions, including our May 22nd session, when our topic is going to be focused on estate planning. So now on to today's show, right? And today's topic is very timely. I'm sure everyone has thoughts, worries, questions about what the heck is actually going on, right? There's a lot of confusion out there in the marketplace. The market doesn't seem to know which direction it wants to head. And that might be making a lot of us think, what should I do with my portfolio? So we're going to explore some of those questions. Along with hopefully diving into some insights into our own brains and the reason behind why we get that itch to maybe do something at a moment where it's probably not in our best interest. So today's speakers are both great advisors here at Apella and both great friends as well. Leading off today's session is Shawn Steele. And Shawn, after several years as an attorney, did a career pivot and became a certified financial planner. He works in our Reston, Virginia office, where he focuses most of his time on working with federal employees. So as you can imagine, not only is he dealing with a little bit of gyration in the stock market, but also those federal employees and all the hecticness that they're going through as well. So he's really at the epicenter of a lot of the turmoil going on in Washington these days. Our second speaker is Phil Calandra, and Phil's an all-star out of our Atlanta office. Phil also has quite a diverse background, previously spending many years as a consultant for Fortune 500 companies such as Coke and UPS, which also will bring an interesting background to our discussion today, considering I'm sure many of you have questions on things like tariffs. So let's get rolling, and I am going to turn it over to you, Shawn, to get this event started. So welcome, Shawn.
Thank you, Jason. On behalf of myself and Phil, it is a pleasure to be here with everyone today. We're very glad you're able to join us. I'm sure you have a lot of concerns about the stock market. With the new presidential administration here in Washington, D.C., there have certainly been a lot of news headlines. And a lot of people are asking, how should I position my portfolio for the new administration? Will tariffs impact my portfolio? And how are changes in international relationships going to impact my portfolio? So a lot of questions. While there's been a lot of headlines, I have some good news, is that the best investment advice that was true yesterday is still true today. We want to invest for your risk tolerance and your risk capacity. We want to diversify across companies, countries, and sectors. We want to focus on the things that we can control. So some of the stuff in the news is going to be out of our control. We want to focus on the things that we can control. Take a long-term view, and most importantly, don't react to the market. And that last one is probably the most important about not reacting to the market. We have so much news available to us today. We have 24 hours a day, 7 days a week news. We can get alerts on our cell phones. We can get bombarded with headlines and stock market alerts. And the problem with all this information is it feeds into known psychological biases that lead us to make harmful investment decisions. There's a good deal of research and a field of study on behavioral finance. And the good news is there's a lot of research that we can draw from and learn how to become better investors. And pull up a quote here. This is from The Psychology of Investing. This is going to be a little bit of a theme for the first half of our presentation, and this is a quote. It basically says that the media kind of has a bias towards storytelling, but that bias towards storytelling kind of drives us to try and pick stocks and time the market, and both of these things we know not to be good for our investment portfolio. So with that, we're also going to kind of talk about a little bit about the Dalbar study. Phil's going to talk about the Dalbar study. Dalbar does a study every year, and one of the things that they find consistently from year to year is that investors tend to underperform. And so we're going to spend a little time talking about why that is the case. And it's important that we have an understanding of this, because when we build your financial plan, we make assumptions about spending and savings, when you're going to retire, and so on. And one of those assumptions is what investment returns are going to be. Now, we have a pretty good idea what investment returns are going to be for a given allocation over a long period of time. But the one thing that we don't want to do is make sure that what we want to make sure that we don't do is, make decisions based on these known biases that lead to harm, because that can cause us to underperform, and that can change how much we have to save for retirement, or even how much we can spend in retirement. So with that, we're going to kick it off, and I know politics is on everyone's mind. So you may be asking, is there a correlation between which political party has control of the White House and the stock market? And I have good news for you. We have a lot of data on that topic. So this first slide here is showing you the growth of the S&P 500. That's the largest 500 U.S. companies. We're going all the way back to 1926, so almost 100 years of data. And you can see that the growth of a dollar has an upward trend, meaning it keeps growing. And you can see we've marked here where different presidents were in office and color-coded it based on party affiliation. Now, if there was a correlation between the stock market and party control of the White House, you would expect the slope of this line to change depending on which party had control of the White House. And you can see that the slope of the line doesn't change depending on which party has control of the White House, that it continues growing in an upward direction. And we can even take this a step further and take a look at, well, what about Congress? Congress is part of this equation too. Does it matter if, who has control of Congress? So same data again, S&P 500, going back to 1926. And the same story, the slope of the line doesn't change depending on which party has control of Congress. And Jason, it looks like we have a question here. Jason, you're muted.
Sorry, I was trying to pull it up and I accidentally clicked away from the box. So, as we think about international relations, right? And do you think, given that it might be souring with investors abroad, do you think that's going to impact U.S. companies and maybe cause the U.S. stock market to continue to drop?
That's an excellent question. The two things that we need to keep in mind about it is, one, geopolitical events are very hard to predict. And the other part is you have to also predict how the stock market is going to respond to the geopolitical event. So there's two parts that you have to get right if you're going to try and time the market. You have to correctly predict what the geopolitical event is and the market's reaction to it. And research shows that we don't do that as humans. We don't do that very well. So the best course of action is to hold a mix of U.S. and international stocks in your portfolio. U.S. international stocks don't necessarily go up and down at the same time. Year to date, that has certainly been true. U.S. stocks have been down year to date, up the last couple of days, but overall down year to date. International stocks have been up. So by holding them both in your portfolio, you don't have to guess who's going to be the winner and who's going to be the loser. And in fact, I'm going to share a slide with you that kind of illustrates the reason why we don't want to try and pick winners and losers, because it oftentimes is going to hurt our investment performance. So this is showing you the growth of the MSCI All Country World Index. So essentially all the stocks in the world. The bar graph on the left is showing you got a 10.8% return if you held all the companies between 2009 and 2023. if you were trying to pick winners and losers, and you happen to exclude the top 10 performing stocks each year, well, your return went from 10.8 to 8.1%. And if we go one step further, you can see in the bar graph on the far right, the one in red, if we excluded the top 25% or top 25 performers, our return went to 6.9%. So the problem is there's no reliable way to pick top performers. And when you're trying to guess, you're very likely to hurt your investment performance, as you can see here.
So just to interrupt you again, sorry, but we have a question from Emily about tariffs. And how do you feel about tariffs impacting the market right now?
That is another good question. There are certainly no shortage of people on TV right now giving their forecast and opinions about tariffs in the stock market. We do need to be, this area is particularly, we need to be careful about something called confirmation bias. I'm going to get into that in just a minute. But for now, know that confirmation bias can lead us to make decisions that hurt our investment performance. The other point that I would make, I got two other points about tariffs that I would make, is one is the cause and effect relationships are a lot more complex than the forecasters often imply when they're on TV. And the other point is companies adapt. And sometimes they adapt in ways that might seem surprising, or maybe it's a way that we didn't logically foresee. Just to give you an example, Harley Davidson has had to navigate tariffs, and as we know, Harley Davidson's makes motorcycles. They're very proud of the sound of their motorcycle. Has a very distinct sound. They sell their motorcycles here in the United States, and they sell them abroad. And they've had to navigate these retaliatory tariffs. So they were selling in China, and then what happened when the trade war started, China applied a retaliatory tariff to their motorcycles. And the problem with the tariff was it made it hard for them to sell in China at the price point they wanted to be at with the tariff in place. So their solution was they shifted some manufacturing from the United States to a country that was not impacted by the tariff. And that allowed them to sell in China at the price point they wanted to be at. Now, the only point I make is that companies find ways to adapt. That's really the whole point of that. And, in terms of our portfolios, we know the stock market's going to go up and down from a given year. And so when stocks are down, that's a time to rebalance. So we want to move money from bonds to stocks. And you can think of that as buying when their stocks are on sale. So if you think of that old adage, buy low, sell high, that's kind of what we're doing when we're rebalancing. If stocks do well, you want to sell some stocks and move money to bonds. That's the sell high part. Where people hurt themselves is by reacting to the markets. And when they're chasing the market, if the stocks are way up and they're like, okay, now I'm ready to get in, or if the stock has dropped way down, now I'm ready to get out. What you're doing in that scenario is you're doing the opposite of what you should be doing, because you're buying high and selling low. It's the opposite of what we want to do. So great question. So now, a second ago, I mentioned there was something called confirmation bias. This is something that gets studied fairly frequently here in investment psychology. But really, it's really simple. Confirmation bias is really when we have an idea about something, and we look for the evidence that proves us right, and we ignore the evidence that proves us wrong. And if we stop and think about how many times in our daily life we do that, we do it a lot, right? Because if you think about how many times have you gone to the internet and Googled something to prove yourself wrong, none of us do that, right? But we need to be very careful about it when it comes to investments. And so I have a simple example. Don't overthink this. We have a polling question. We're going to try and poll the studio audience here. And don't overthink this. So, and you have to vote. So the question here is, which animal is more dangerous, the shark or the cow? So number one is the shark. Number two is the cow. Don't overthink it. Just kind of go with your gut, and we'll kind of talk about it. So I'll give you a couple seconds to get
the votes. They're flying in fast and furious right now. So let's we are getting close to having 100% voting here.
All right, 100% participation.
We're getting very close to those slackers who have not yet voted on an animal. Let's get going here. All right, I think we've got about 90% of the vote in. I'm not sure if you can see it, but so right now, for shark, it is 53% of the vote, and for cow, it is 47% of the vote. So
Okay, all
the
right.
audience is flipping a coin here.
All right, all right, so the audience is flipping a coin. Okay, so the one way we can approach this problem is we can say, okay, I know the shark is a predator. The shark has shark teeth. It's strong. It swims fast. If I Google shark attacks, I'm going to get a bunch of news articles on shark attacks. The cow lives on a farm. It's docile. It's an herbivore. I've never heard of a cow attack, so I'm going to pick the shark. Now, what's the right answer? Turns out it's the cow. On average, the shark kills 1 American per year. The cow kills about 20. If we go back to the way I kind of just walked through the way that I was kind of picking the answer, I started with the initial idea that the shark was dangerous. I did a little research that confirmed it, but I didn't do anything to think about the cow side of the equation, right? I didn't try to prove myself wrong. I didn't, search to see how dangerous cows are. Now, that same thing, that same philosophy, that same problem can come up when we think about our investments. So let's say you have Apple stock and you're inclined to sell it right now. So you go to the internet and you say, is now a good time to sell Apple stock? Well, the internet gives you articles that say now is a good time to sell Apple stock. Now, but let's see what kind of articles we get if we ask the opposite question. So if instead of asking, is Apple a good time to sell Apple stock, what if we ask, is now a good time to buy Apple stock? Well, interestingly enough, you get completely different articles. And so I love some of the titles of these articles. Could buying Apple stock set you up for life? The one in the middle here, 3 reasons to buy Apple stock like there's no tomorrow. And the one on the right here, should you buy Apple stock hand over fist before February 19th? It's pretty specific. Now, the point in this is I ran these searches on the same day, approximately 1 minute apart. And depending on how I asked the question, I got completely different articles. And the point is that, the internet is kind of ripe for leading us to make decisions based on confirmation bias. And, we've talked about the internet so far, but I also want to mention social media in a lot of ways is even worse. Because social media, if you go out to social media, it gives you articles based on what it thinks you like. It's going to give you articles based on what it thinks you want to hear. And so the combination of the internet and social media can really set us up to make investment decisions based on confirmation bias. And it can even lead us into something else too. It can make us a little overconfident because we can see a whole bunch of articles that are reinforcing the initial idea that we had. And seeing, other people kind of agree with us can kind of create this overconfidence. So how do we counteract that? Well, 2 things. We need a formal process, and we need to make sure we're looking at all of the evidence. So for the formal process, one of the things that we have here at Apella, and as you as clients, we have an investment policy statement that says we're going to govern your portfolio to a certain percentage of stocks and a certain percentage of bonds. And when it gets out of balance, that's when we're going to rebalance. So having that formal process helps manage, it helps, prevent from making decisions based on confirmation bias. The other thing is we want to look at all the evidence. We kind of talked about the market being down, and there's kind of a feeling like we're in a crisis a little bit in some ways, but sometimes it's helpful to take a step back and look at, maybe look at how frequently crises come up. So this is looking at from 1970 to 2023, the growth of the MSCI World Index again, and you can see it's got an upward trend here. But you can see here, just kind of eyeballing it, there's a lot of different crises on this graph, and it's almost like they happen a lot more than we think. Almost kind of like we kind of expect crises to happen. But if we think about some of the more recent ones, like say COVID-19 or 2008, when we were living through it, there's probably 2 things that we felt at the time. One, we probably didn't feel like we're going to come out of it, but we did. And the second one was we probably felt like this one is different this time. And the thing that I would say is if you look at all these crises on this chart, there's something unique about each one of these crises that makes it completely different from every other crisis that's on here. So when we're going through these crises, remember, we're going to come out of it. And even though it's unique, that doesn't mean that the market's not going to recover. All right.
So just
Yep.
it's interesting that you mentioned that, because I think that's, in terms of behavioral finance, right? That's recency bias. We always think whatever we're going through right now is the worst. And I will say in the comments or in the questions, there's obviously been a few comments about the current administration and how it is different this time. Maybe you could talk a little bit about recency bias and overconfidence and just kind of give us a little bit more information, because I think that the psychological perspective, it's important to kind of remember this is a new and exciting area of finance for all of us. And there's been Nobel Prizes awarded
Yeah.
in behavioral finance. Like, there's some exciting things going on in this space, and being more aware of our biases, I think, is really helpful.
Yeah, so recency bias is kind of when we anchor to something recent, right? Our brains are kind of naturally wired to do that. The problem is it can set us up. We can anchor to stock prices. We can anchor to a lot of different things, but we want to be careful about it because it can cause us to anchor on to the wrong thing. Now, what I want to say is, maybe to some extent this is a unique crisis in a way, but remember, we have this built into your asset allocation, and we also build this into the financial modeling. So built into both of those assumptions is that we're going to experience some crisis. We don't know what the trigger is going to be or when they're going to occur. But in terms of your portfolio allocation, one of the things that we want to make sure of is that you're invested for your risk tolerance. And we're not investing you, if the stock market goes down, we're not investing you in a stock allocation that's going to cause you to bail. So that's one way we can control for crises. But in your financial planning, the other thing that we assume is that, we don't assume that investment returns are going to be the same return year after year after year from now all the way to the end of retirement. That's the one thing I'm 100% sure is not going to happen. Instead, what we do is we model different trials with different sequences of returns, some years up, some years down, because we know we're going to go through various crises, and they're going to, the stock market's going to be down maybe 10, 20% one year, maybe up 10, 20% the next. So we want to build that in. So that's built into the modeling. So this idea that crises are going to occur, we don't know when they're going to occur or what's going to trigger them, is built in two places, into your asset allocation and into the financial planning modeling that we do. So great question. So we talked a little bit about, social media. I do want to actually kind of talk a little bit about our social environment as well, because it turns out our social environment can impact the financial decisions we make. The author of The Psychology of Investing that I mentioned earlier, he talks about how we form peer groups based on shared values and beliefs, and that kind of makes sense, right? We make friends with people we have something in common with. But financially, what that can mean to us is if my friends aren't savers, I'm less likely to be a saver. If my friends value spending, I'm more likely to be a spender. So we want to be careful about the company we keep. But there's a lot of really interesting studies that we can draw from. For example, social households are more likely than non-social households to participate in a 401k. If your neighbor buys a stock, you're more likely to buy some of that same stock. But there's a team of researchers did a study that I love, and they did two studies. The first one was looking at participation rates among library staff. So this was a university. It had 11 different libraries. Each library was kind of its own island. The library staff didn't really interact with the other library staff in the other buildings. But it allowed the researchers to control for things like education and occupation, because everybody pretty much had the same kind of education and occupation. And if our social environment had no impact on our financial decisions, we would have expected the participation rates among the libraries to be essentially the same. Instead, what they found was the social environment within the library impacted the participation rates among each building. So you can see here, building 11 had the lowest participation rate, and building 1 had the highest participation rate. So if you're going back to what we kind of talked about, how your peer group, if saving is one of their values, it's more likely to be one of your values. So that's kind of what's going on here. But the researchers followed this up with another study. I absolutely love this study. This is a great study. They had an educational workshop, so similar to what we're doing right now. They had an educational seminar on personal finance, and there were 3 groups. The first group got a $20 reward for attending. The second group did not get the $20 reward, but they knew somebody who was going to get the $20 reward. And the third group did not get the $20 reward and did not know anybody that was going to get the $20 reward. So as you might not be surprised to know, Group 1 that got the $20 reward had the highest attendance rate at the financial education seminar. Group 3 had the lowest. Now, here's what's interesting. Group 2 was more likely to attend the financial workshop just by knowing somebody who was going. That made them more likely to go. Now, here's where this gets really profound and powerful. Just by knowing somebody that was going caused them to be more likely to go. And then when they went after that educational workshop, they were more likely to participate in a retirement plan. So something as simple as someone saying, hey, I'm going to an educational workshop, you want to go, can have a profound impact on someone's life. Because if you stop and think about the differences between those two outcomes, between not saving enough for retirement and saving enough for retirement, those are two dramatically different outcomes. And something as simple as inviting someone to an educational workshop, just like what we're doing here today, can have a profound impact. So on the social thing, all we need to really know is that our social group can influence our financial behavior, but like we said, we can also influence our social group with something as simple as inviting them to the webinar. And we talked about how crises can make us feel unsettled and recency bias. And I'm going to turn it over to Phil now, because Phil's going to talk a little bit how mental discomfort can lead us to make investment decisions that we should. And he's going to talk about the Dalbar study a little more.
Yeah, thank you, Shawn. We'll go to the next slide there. So I want to illustrate something in the simplest form, as simple as I can. So you're driving to the supermarket tonight, and your family really loves tuna salad. So you have a lot of cans of tuna fish in your pantry. You walk into the grocery and you discover in the front end cap that there's a manager special on your family's favorite brand of tuna fish. It's normally $2.99 a can, and it's on sale for $1.99, and there's no limit. You then mentally think, how much room do I have in my pantry? You back up your shopping buggy and you do what? Right. You put as many cans of tuna fish into your shopping buggy because it's on sale. And we do this routinely in every economic area of our life, largely, except when it comes to investments. And this has been studied for years. And in fact, it was studied originally by John Maynard Keynes, if you're an economist. So this goes back 60 plus years, and the empirical data and the academic research is contra-cyclical versus pro-cyclical. And basically what it shows us is the way God wired us is a little bit off. In every area of our economic life, we search for things that go on sale. Why do you think Amazon.com has Prime Days? Why do they have back to school sales in July and August? Because our propensity as consumers is to gravitate to the thing when the price is falling. But when it comes to our investing, our 401k, our trust, our children's 529 account, we do the opposite. We're pro-cyclical. We run from the thing when the price is falling, as opposed to gravitate to the thing when the price is falling. So those of you on the call tonight, clients that are in the accumulation phase of your investing timeline, it's just like having the manager special. You should look for every opportunity with your advisor to accelerate the purchase of those things that you know you're going to need in the future, which is your investment portfolio. Now, I will submit to those of you who are already retired, you take a little bit different approach, because maybe you're not purchasing cans of tuna fish for the pantry. You already have your pantry full. If you were the person that said, I don't have any more room in my pantry, that's the retiree. There's no more room for the tuna fish. Same thing for a retiree. If you're done accumulating, I grant you that. And there are ways to fix that. We can maybe address that at the end.
Phil, let me, there's a question from Judy in the audience, and I think it relates to exactly what you're just talking about there, accumulators and decumulators. And Judy's 84. She's got a 50-50 portfolio. I'm going to make an assumption it's something in the Apella universe, but I don't want to pretend that I know what's in each of the buckets there at 50-50, stock to bond. But her comment is not having enough time to wait for an eventual a rebound. Now, I know probably a 50-50 portfolio is done better than Judy might expect, so I would encourage you to reach out to your advisor and kind of talk through that. But how do you think about that from a planning perspective, or like how to position your portfolio if you are in the decumulation, if you need a certain percentage of your money from the portfolio, and there's an expectation at some point, like Shawn was talking about, there will be bumps in the road. So take us through that for the decumulators.
Yeah, absolutely. And the key word that I heard you say, Jason, was plan. And that's what all of our economic decisions have to be rooted on. If you walk into the grocery tonight and you're not in the market to buy tuna fish, you're going to walk right by it. That would be the case for our retiree client. But you already planned ahead. That's the purpose of doing good, academically proven financial planning activity. I would even go so far as to say that's where an income plan is very specific. Instead of reinvesting dividends, maybe you take dividends in cash. In a 50-50 portfolio, it's likely that there's going to be some interest thrown off. Maybe you have isolated the next 6 months in cash, because cash now, finally, we can get a 3.5–4% yield. The 10-year, the 1-year T-bill is sitting at 4%. There were years when you could get nothing on cash. So that would be more of the income planning design under the context of what you're doing with your advisor. Is it's already having the plan, and I'm going to talk about this in a minute. It's largely a battle plan that's already on the shelf. It's just like going to the supermarket with a shopping list. You may have tuna on the shopping list and you're loving it on sale, but maybe tuna fish isn't on your shopping list. But the battle plan was already in your mind, and that's no different whether you're 22 or 82 or 84.
Great, thank you.
Yeah, next slide. Thanks, Shawn. So this is one of my favorite charts, and it dovetails a little bit in the one that Shawn showed earlier. This is put out by JP Morgan. It's in the JP Morgan Guide to the Markets. I love getting this every quarter. But what this slide shows is all the way back to 1980. Again, this is the S&P 500, the great American companies, highest, largest capitalized companies in the world, frankly. And it goes back to 1980. And what it shows is intra-year, so that means within a calendar, from the peak or the high point of the year to the low point of the year, there is an intra-year decline of 14.1% every single year. Whether we call it a correction, whether it's a bear market, whether it's COVID, whether it's Y2K, it largely doesn't matter. This time isn't any different when you look at something that shows you over the last 45 years, whether we need it or not, there is a 14.1 correction. And if you look over the 45 years, 34 of those years, the market finished positive. But while we were intra-year, wasn't it painful? Yes or yes. Look at any of those red dots where within the year that we saw 30, 11, 10, 19, 29% gains in our portfolio as measured by the S&P 500, you also had to be in your seat with the seatbelt on, looking neither left or right and just continuing to go down the path that your financial advisor and that your plan dictated. Because if you did look left or right, if you did get out of the seat when that red dot appeared, what did you do? You basically eliminated potential for opportunity or potential for the portfolio to grow. And that's really, really important. And we mentioned recency bias a bit ago. If you look over the last couple of years, we haven't even hit the 45-year average of 14.1%. Last year in 2024, the market only went down 8% within the whole calendar intra-year cycle. That does not happen very often, but that frames, to Shawn's point, that recency bias. So be very, very careful. The market, to me, as measured by the S&P 500, this tells me the market permanently goes up. It temporarily declines. And I'm not dismissing that those declines are extremely painful, especially for those that are retirees that are watching their life savings drop temporarily. Don't look left or right. Yeah, go ahead. Question?
I was just going to say this dovetails pretty nicely into what Shawn was talking about earlier about missing the best days in the market, right? You look at 2024, the market dips 8%, or 2023, you see the market dips 10%. Maybe you got out at those moments, right, Phil? But then you miss those best days, and your return now isn't 23%. It's some level below that.
Absolutely. And the best example, 5 years ago now.
Yeah.
Look at the 5 years back in 2020, the red dot, the market went down 34% in 33 days. That had never happened. So we would say, well, this time certainly is different. We have the 100-year plague. And if you panicked out, what did you miss? My eyes tell me that the red dot was 34%, but we still finished the year up about 16. Is that 16 or 18? So that proves the
16,
point. Yeah, proves the point. Love that slide. Next, Shawn. So Shawn mentioned the Dalbar study. This is very interesting. So Dalbar is a company that studies investor funds, inflows and outflows, and they determine what the average investor earns based versus the average fund. And they do this in equities, they do this in bonds, they do this in a blended portfolio. Jason, you mentioned like a 50-50. It could be a 60-40. But what I'm showing you here is just purely the equity portion of the study. So going back 30 years to 1994, you'll see the far right, the S&P 500 has an average annualized return of 10.15%. Most people know that. We could draw this back to the 20s, and the average still is about 10.2%. Over that 30-year period, while the S&P 500 was averaging 10.1% effortlessly, with a 14.1% average decline every single year, whether we needed it or not, the average equity investor only earned for themselves and their portfolio and their family 8.01%. Why? Because the average investor doesn't even perform as well as their investment, because they're fixated on this time is different. They're doing what Shawn suggested in they're Googling. If you didn't pick this up, when he showed the Google results, should I buy Apple stock? The #1 search result he showed was by Motley Fool. When he flipped it and it said, should I sell my Apple stock? The #1 article was by who? The Motley Fool.
Yeah.
So who's the fool here? So the average investment outperforms the average investor. Why? Because we're flawed. It's a human proclivity to do the wrong thing at the wrong time. Why? Contracyclical, pro-cyclical. In our money and investment and economic lives, we flee things when the price is falling instead of gravitating to them. And then the bottom portion of the slide shows the investment, the growth of $100,000 over a 30-year period. And many of you on this call had your 401k running and gunning in the 90s. $100,000 turned into 1.8 million. If you were seated and you didn't look left or right, you continued down the path versus the average equity investor, which lopped off $800,000 of the potential return. Why? Human nature is failed as an investor. And the sooner we recognize that, the sooner you talk to your advisor about that and build in the battle plan, as I call it. And it's largely a psychological battle plan. Don't be an investor if you know you can't stomach the ups and downs, the previous chart. Come to realize that that's part of it. If you want to earn the 10% average return over the last 30 years, you have to be willing to sit through the intra-year decline of 14.1% on average. And oh, by the way, every 3 to 5 years, we're going to get a bear market. That's going to be average about 33% decline. And it's kind of like the crosstown bus. if you just wait 10 minutes, the next one's coming by. So if you know that's going to happen, have that conversation with your advisor and build that into your battle plan, your financial plan, as we would call it. And largely part of that plan is psychological, because that's the way God wired us when it comes to money.
We talk about it all the time, right, Phil? It's not timing the market, it's time in
the market. That's right. That's right. Okay, next slide, Shawn. So this is one of my favorite quotes. This is by, of course, the legendary, the myth, the legend, Warren Buffett. Your portfolio is like a bar of soap. The more you handle it, the smaller it gets. Very, very simple. Is it easy? No. When you're getting 24/7, minute by minute, click by click bait about what you should do, it amuses me. When you go to the grocery tonight looking for the manager special, in the checkout counter, look at any of the financial rags. And every one of them, I get a kick out of it. The beginning of every year, they tell you, you must own these 5 stocks now, or your portfolio will zoom to new heights with these 3 funds, or whatever it is. And it's comical, because the more you handle in and out of investing, the less you're going to have. That's just been proven. Be careful of that. If you have this itch, this nervous itch, or this propensity maybe to do something drastic to your portfolio, do me a favor. Call your advisor first. Let them sit down with you. Let them talk with you. Let them understand it's okay to have the feeling. We are all human. I feel it too. I don't like to see my family's money lose value, but it's okay to feel it. It's not okay to act on it. Don't be reactionary. Be proactive with your plan, your battle plan, your psychological battle plan. Don't act on the emotion, because it's like the bar of soap. And one other quick graph that I like. What gets attention is rarely valuable. And you could insert any little icon that you wanted in this. Left axis is value. Bottom axis is attention. So what you see, what gets the most attention? The daily market movement. How volatile has it been? And oh, by the way, volatility is not always on the downside. If you remember, was it a week or 2 weeks ago, Jason, the market shot up 10% in one day. Nobody was squawking about that volatility, but volatility cuts both ways, on the downside and the upside. But that's what gets the most attention, the daily market movement, or today's headline. The catastrophist headline is always shrieking and shrilling about what it is we need to worry about. What really has the most value, going further to the left, is market history, having the right perspective, and then ultimately having the battle plan, the financial plan, having it measured. And what's the carpenter rule? Measure twice, cut once. So if it's time for you to sit down with your advisor and have a look-see at the financial plan and run through your e-money scenarios, maybe you want to add a scenario or two, delete a scenario, run your Monte Carlo, run the simulation. There's much more value in that conversation than you scrolling through feed after feed after feed, or heaven forbid, turning on the TV tonight to CNBC and seeing the guy banging the buzzer and the sleeves rolled up and, yelling. I don't know, that's entertaining, but I don't think it has a lot of value for those that are looking for long-term portfolio growth and creating measurably better financial outcomes for their family. So pay attention to the things that carry the most value. So some key takeaways, and we'll run through these real quick. I know you can read them. Your financial plan is the way. It is the battle plan when the market temporarily drops. It hasn't proven to us yet that the market does not come back. If you go back to COVID 5 years ago now, about this time, look at what the S&P 500 did in COVID, March, April months versus where it is today, even though we're down year to date. It's about 100% gain, cumulative. Successful investors act. They act on their plan. They never react to the market fears and fads. So right now we're seeing a lot of volatility. Most people think it's on the downside, but there will be another massive upswing. Don't know when, don't know how. Don't react to the fad either. Stick to the portfolio that is dictated by your goals, which is driven by what? Your financial plan. Thirdly, the broad equity market historically drops 4.1% every year. It's like the crosstown bus. We didn't have a 14.1% drop over the last 2 years. Could it be that we just were due for some type of pullback, some type of reset of some of the PE ratios and the valuations? I would submit that's probably accurate. For a globally diversified portfolio is a proven way to sidestep some of the volatility on the downside. Shawn mentioned that. There were many years where the US large cap market was just trouncing the international market. Did you abandon it? I hope not, because year to date, that international exposure is helping lift the temporary decline of the US markets. And then finally, this time isn't different. It's just not. Shawn showed the chart with all the different events. There will be another event. There will be another catastrophic thing that drops the market. But I would tell you, through all the events, investor behavior, the way we will think about investing is the dominant determinant of real life investment outcomes. Now, let me be clear. I didn't say predominant. Predominant would only mean that behavior was greater than any other. The dominant determinant means it's greater than all the others put together. And, Shawn and Jason mentioned, the economic study, the Nobel Prize was awarded back in the 50s. I think it was Markowitz that won this particular one. And basically they showed that the greatest determinant was, in fact, being in the market, not market timing, not selection, buying the haystack, not the needle. So in other words, not trying to pick the winner, but just buy the whole horse race. This time isn't different. Dominant determinant is us. Human nature is failed as an investor, and we're here to make sure that you don't fail as an investor with good financial planning and the right portfolio to solve the goals driven by the plan that you've created. That takes us to Q&A, right, Jason?
Yeah. So can you still hear me okay? My computer's a little glitchy at the moment on my end. You still good? Okay. Shawn, this relates back to a question that maybe we hinted at earlier about US and its perception in the marketplace. Is there any potential disruption in those upward trends that you showed in those charts based on where we sit today? And that question comes from Kathleen.
So I would say stock market volatility is normal. I think that's one of the points that we need to raise. Companies adapt, and what I would say is the way that one way to think about the volatility in the stock market being down is it's not that there's going to be a disruption in the trend of it being upward. What I would say is investors are requiring another way to think about this is investors are requiring a higher expected return. And the way that they're getting that higher expected return is by paying a lower price for the stock. So I would not expect that the trend of upward trajectory is going to stop. I think it's just that investors are looking at this saying, I'm going to require a higher expected return, and the way I'm going to get that is by paying a lower price.
Question for you, Phil. You had talked about the underperformance of individual investors. And it seems that you were suggesting most of those things are related to people's behavior versus underperformance of those investments. I think Vanguard has done studies on, I know they have, on the alpha that an advisor provides because, we're kind of not emotionally connected to people's money. So can you just talk a little bit about that relationship, about why not only the plan, but, having somebody who doesn't have that emotional connection to your own money can be super beneficial?
Yeah, the evidence is empirical. It's pretty clear, and that is our own human nature, our human proclivity with being contracyclical is to fear and run away from something as the price falls. So the problem with all of the economic data, with the academic research, is that when the portfolio, forget the container that it's in, forget whether it's the S&P 500, the Russell 2000, maybe it's emerging markets, forget the box. But if our human nature is to flee something when the price declines, that creates the problem all along, because now you have to get out right and you have to get back in right. And nobody can do that. As soon as somebody figures that out, let me know and we'll take it on the road. But that becomes the problem all along. So because we're thinking, and I'll be honest, I look at Wall Street in some ways as detrimental, because Wall Street manufactures all of that content that journalism and financial media suck up and print or air. And that's not really helping anybody. If it was helping anybody, none of you would be on this call right now. You'd be in Bora Bora in your tiki hut, right? But we all have a purpose for investing. And if we allow that emotional, it's just the human proclivity. We're failed as investors. I just always come back to that. I think if you develop first, so break it down, 3 steps, very simple. Articulate your goals to the advisor. If you're your own advisor, if you're a guest of ours today, you're looking in the mirror. That's your guidance there. Determine what the goal is. What's important about the money to you? Because what it's important to you is different than what's important to me or Trish or Jason or anybody else. Determine the goal. Build the plan that historically has produced the outcome of your goal. And then build the portfolio construction around the plan. And people that fail as investors don't do that. They let their gut, what does gut stand for? G-U-T, gave up thinking. So gut intuition is a bad way to invest. And you're giving up your ability to think with the battle plan, as I call it. And that deteriorates the psychological battle plan. Obviously, it starts there.
Shawn, you touched on, there's some questions about different areas of behavioral finance. You touched on things like confirmation bias earlier, right? Kind of finding information that backs your thought. You touched on overconfidence and the idea of, maybe I guessed right during the last crisis, so I'm really good at this now. Maybe you could touch a little bit about, loss aversion, and the idea of, people just feel that pain more on the downside than the joy of the opposite, right? I mean, that's kind of what we all experience with folks and the phone calls that we get over time.
Yeah, that's a great question. So loss aversion is, where we make decisions based on this idea that, the pain of losing is going to be greater than the joy of when my stock performs well. And that's a very real phenomenon. And the way that you kind of have to prepare yourself for that is, one, you have to understand that volatility is normal, and quite frankly, it's essential, because volatility is the way that the markets are pricing in new information. And if we just stop for, and think about what is a stock? Well, when I have a stock, I have shares, I have a future ownership in a company's future cash flows. And so really all the market's doing is pricing in, what price do I need to pay to get an acceptable return on those future cash flows? And so really the volatility plays an essential role in making sure that the investors are appropriately compensated in the long run. And that volatility is honestly the price you pay for getting returns greater than inflation over the long run. So you have to kind of start with the place that volatility is essential. Loss aversion is natural. We all feel it. And the way to counteract it is kind of similar to what we would suggest with confirmation bias, is it comes back to having an investment policy statement and an asset allocation that's based on how much risk are you comfortable taking. If you saw that your portfolio was, during a bad year, like say 2008, if that was going to drop 10% and that was too much for you to stomach, well, then that's too much risk. On the other hand, if you feel quite comfortable with that drop, then maybe that's about the right, the right allocation for you. So the way to kind of manage that, it comes back to having a discussion with your financial planner about, how much risk are you comfortable taking, and working with them to find out the appropriate allocation for your portfolio.
Yeah, one thing that I'd add to that, Jason, is there's a professor from the University of Chicago. His name is Richard Thaler. You could Google this gentleman. He spent damn near his whole career proving loss aversion, which was we as humans feel pain 2 times as more than we feel gain in our portfolio. And this was done back in the 80s and the 90s because we feel the fear of losing money is 2 times greater than the joy of gain in our portfolio. And I believe that was a Nobel Prize, if my memory is right, Richard Thaler.
Yeah, Daniel Kahneman won it in 2002. I don't know if Thaler got one, but that actually, it's interesting because we're financial planners. People think of us as math guys, plan guys, and gals. But it really does dig pretty deep into coaching, psychology, behavior, and it's a really growing field in our industry where Nobel Prizes are being awarded in these areas of study, which is really exciting to see because for a long time there was no way to measure what we were doing correctly or incorrectly around. Were we getting lucky? Was this luck? Was it skill? Were we building this overconfidence, underconfidence? Like, were we looking out and trying to find information to back our ideas? Now we've got labels to really help us identify these trends and these mistakes that we're making over time. So it's been a really exciting area of study. Phil, one last thing for you before we wrap up here, and I think I think the question is about the portfolio and its level of diversification. But Bill was asking a question. It seems that the stock market is down significantly more than my portfolio currently. I'm invested in about 70% stocks, but it seems like it should be a lot worse. I don't know exactly what that portfolio looks like. My assumption is there's some bonds in there, being only 70% stock. There's some international stocks. Maybe just talk a little bit about how we perceive, when we talk about the market, people expect the S&P, the big market, but we don't think of it that way here at Apella.
No, and that's good news, Bill. Congratulations. Maybe call your advisor in the morning and thank him or her. and the reason, so it's not coincidental, but the reason that a 70-30 globally diversified portfolio has done better than a very narrow 505 large companies in the US is because, to your point, Jason, there are some bond classifications in there that are kind of treading water. They're, moving up a little bit. International is shooting out every light in the joint. Emerging markets doing fine. So of the 70% equity allocation, you've got part of it that, yeah, you look at it and you're like, man, I'm bleeding out here. But you have other things in the portfolio that are lifting the boat, so to speak. It's helping to buoy that. So in Bill's case, if your financial plan and your goal structure dictated to construct a 70-30 globally diversified portfolio, I'd say stay the course with this. You're hitting exactly, you're right down the middle of the fairway, and keep doing that.
Yeah, it's interesting. It goes back to even, 2 decades previous, right? The lost decade, where US stocks underperformed for a full 10 years, net negative, and then you see how international and emerging propped it up. And that speaks to why we have exposure to all these geographies. Absolutely. Consistently throughout moments like this. We're not kind of ebbing and flowing based on what we think might happen tomorrow or reacting to what happened yesterday. So, absolutely. We're right on time right now. So I know there's a few other questions that are still in the chat that we weren't able to get to. I apologize for running out of time. They're good questions. We will forward them on to your advisors for responses. We really appreciate everybody digging in here and spending their afternoon with us. If you have other questions that you didn't get a chance to ask, or you want to reach out to your financial advisor to have a further discussion about any of these topics, please do. If you found this webinar valuable, we would encourage you to share this with your friends. We'll send out the recording, send it with friends, families, work colleagues, even your enemies. Share it with your enemies, right? Anybody that might need help in this area of finance. And please look for the invitation coming up for our May event on estate planning. Shawn, Phil, really appreciate you. Great event. Loved chatting with you this afternoon. Learned a lot, and I look forward to seeing you around the halls of Apella. So thank you, everyone. Have a great night. We'll talk again soon.